So, good morning, everyone. On behalf of Affluence Advisory, I extend a very warm welcome to all our participants joining us today for this webinar on scale based regulation, governance, capital, and the reporting priorities. My name is Sadaf Zariwala, and I'm delighted to be your host for today's session. The regulatory landscape for NBFC has undergone a significant transformation over the last few years. With the introduction of the RBI's SBR framework, the conversation has evolved from simply meeting the compliance requirement to building stronger governance structure, enhancing risk oversight, maintaining adequate capital buffers, and strengthening the reporting framework. As NBFCs continue to grow in size, complexity, and the systemic importance, an important question arises. Is scale based regulation merely a compliance framework, or is it becoming a blueprint for building stronger and more resilient financial institutions? That is precisely the discussion we hope to have today. At a time when regulatory expectations continue to evolve, meaningful dialogue between industry practitioners, legal experts, governance professionals, and business leaders becomes increasingly important. So at Affluence Advisory, we work closely with NBFCs across India on regulatory, financial, compliance, and governance matters, giving us a first-hand understanding of the challenges and the opportunities that regulatory transformation brings. It is this commitment to knowledge sharing and practical guidance that has brought us here today. For those joining us for the first time today, Affluence Advisory is a multidisciplinary advisory firm delivering integrated solutions across taxation, transaction advisory, regulatory, finance, legal services for over 2 decades. So, to help us explore today's theme, we are privileged to have an accomplished panel of speakers representing diverse perspectives from the financial services ecosystem. Our session today will be moderated by Mr. Ankit Baid, an MBA in corporate finance and strategy consulting, with experience across equity research, capital markets, corporate finance, valuations. Joining him is CS Atharva Kalu from Affluence Advisory, an associate member of the Institute of Company Secretaries of India, with a strong focus on company law, securities regulation, and NBFC compliance. We are also very pleased to welcome Mr. Abhijit, the Managing Director of Unnati Finserv Private Limited. With over 12 years of experience in financial services, corporate finance, fundraising, business development, he brings valuable industry insights into how NBFCs are balancing growth ambitions with evolving regulatory expectations. Joining us from Wadia Gandhi is Advocate Nihaz Bashir, a distinguished banking and finance practitioner with extensive experience in securitization, structured finance, debt capital markets, project finance, and regulatory advisory. His expertise provides an important legal perspective on the evolving framework governing the institution. And also, we are equally privileged to have CA Ganesh Iyer, a Chief Audit Officer at Avance Financial Services, with deep experience across risk management, internal audit, governance, and regulatory compliance within the BFSI sector. So, a very warm welcome, and we are grateful to all our speakers for taking the time to be with us today. I'm confident that our panelists will help us answer that question through their diverse experience and perspectives and help you navigate this entire framework very smoothly. So, without taking any more of your time, it is now my pleasure to hand over the session to our moderator, Mr. Ankit Baid, who will lead today's discussion. Over to you, Ankit. Ankit, you are on mute.
Am I audible?
Yes.
Yeah. Firstly, thank you, Sada, for setting up such a strong tone to this webinar. And it's my privilege to moderate a panel this strong. My job is very simple here: ask the hard questions on behalf of the panelists and audience and make sure that everyone of you here leaves with something you can act on and not take notes. So here's our roadmap for the next 120 minutes that we would start with the basic foundation of SBR and we would progress our discussion towards the governance and capital, and then further towards reporting and risks. And then with the digital lending ecosystem evolving right now, we would make sure that we also touch base that topic covering the regulatory aspect of the digital lendings. Before I bring in, let me just set the table right. 60 seconds or maybe not more than 120 seconds. So whether you run a compliance at a large NBFC or you just are here for understanding the shift, we are all on the same page. So just for the benefit of the audience, what's an NBFC? So whenever we think on the digital lending ecosystem, we have banks on our top of our head, but banks are not really part of the formal credit system. So there are banks, there are NBFC, there are MFIs, right? So banks focus on the larger secured mainstream borrowers, where NBFC sits right in the middle, where they underwrite those products. They expand to those geographies which banks don't intend to penetrate. So now once we have a basic idea of what an NBFC is, so how does an RBI perceive an entity as an NBFC? So it's not an entity what it calls itself as an NBFC or whatever business it is into, but how does the balance sheet look like? So there's a principal business criteria which comes into picture. So if 50% of if my total income is the financial income, and if 50% of my total assets is financial assets, so that's an NBFC. So that's a basic tone of how the NBFC is defined in the ecosystem, and how an RBI perceive an entity as an NBFC. So now let me just touch base a topic that we are all here for. So for years, RBI had regulated NBFC with broadly one textbook or under one lens. Be it a large NBFC or be it a small NBFC, they were more or less governed under the same structure. So, but as and when the sector grew explosively, they became intertwined in the banking system and the capital markets and the financial system, right? So these entities were way too big to fail. That was the thought, and audience were perceiving that these NBFC are well governed and well operated, and they won't kind of fumble around. So then came the likes of ILNFS and DHFL, right? So these are the large NBFCs which kind of failed, and the shock rippled across the whole financial system. So that's where RBI had understood that they had to categorize NBFCs, and the large NBFCs were less governed and less regulated, and the smaller NBFCs were overburdened with a lot of regulations. So there came the scale-based regulations. So the definition itself tells that you will be regulated on the basis of the scale and risk you take. Right. So this is the context and the foundation of SBR, where as you climb, three things get tighter: the capital, the governance, and the reporting. And that's exactly the journey this panel is about to take you through. So let me just, kind of invite the panel right now. And my first question would be to Nihas. What has changed structurally in this RBI regulatory approach compared to how you have been operating before the SBR kicked in, and how you are operating right now, and with the consistently evolving SBR changes and norms? Nias, you're on mute.
Thanks a lot, Affluence, for organizing this webinar and inviting me. And I think, Ankit, you laid down the background beautifully on how the NBFC space has evolved, etc. All of that. Now, from an SBR framework perspective, obviously, in the wake of the 2008 financial crisis and the aftermath, RBI had put in kind of they realized that the approach they were taking to NBFCs may not have been correct. Previously, it was, initially there used to be just a difference between deposit taking, non-deposit taking. Then there was systemically important, non-systemically important. Then they also tried the different class of NBFCs, whether it's investment company, loan companies, etc. All of that. And obviously, we also ran a parallel thing for housing finance companies, which was not even under the RBI aegis. Technically, it was under the National Housing Board. So what really, if you look at the SBR framework, what it has done is, one, we do not care really from a regulatory perspective what kind of activity you're doing. It is not the kind of lending that determines how you're being regulated. It is more what is your connection or size or dependence on the financial system, what is your inputs to the financial system that really matters on how we regulate. Obviously, in that, if you're deposit taking, still there's a set of separate regulations which will obviously govern you. But apart from that aspect, everything else is pretty much dependent on what is your size and what is your interlinkage with the financial system. So that is the whole SBR system. We initially had just base layer, middle layer, upper layer, which essentially upper layer was a discretionary category, top 10 automatically kind of fell, etc. All of that. Even there, RBI initially started with a lower base for what is the middle layer. They had to increase it to 1,000 crores, etc. All of that. Now, what has happened in 2025 is actually the first step that they did is they wanted to kind of untangle all the regulations. You had a host of regulations which were applicable to different kinds of financial entities. Like they would issue one direction which would be applicable to banks, NBFCs, even like urban cooperative banks sometimes. So scheduled commercial banks, urban cooperative. So what they did first is, I think November 2025, the biggest thing that they did is they untangled all regulations. Each entity now has its own set of regulations. So if you're a bank, there'll be a separate set of regulations which govern you. You do not have to look at the NBFC regulations or any other regulation. Similarly, for NBFC. So even if the regulation is same, so just take an example like say direct assignment or transfer of credit risk regulations, right? It's pretty much the same, but is now covered under two circulars, one for NBFCs, one for banks. So that's the key thing that has happened in November. What is important from scale base is what has been happening since. Because first, they have kind of introduced a new category of classification. Apart from this tier of base, middle, and upper, there's now a unregistered NBFC concept, which is essentially you're not facing the customers, you're not accepting any kind of public funds, and your asset size is less than 1,000 crores. In this case, RBI is saying, I do not want to regulate you really, because you're not a risk to the financial ecosystem. Then there's a type 1 NBFC and there's a type 2. Type 1 essentially is the one that either has customer interface or is accessing public funds, right? And type 2 essentially is the irrespective of size. Sorry, type 2 is the one irrespective of size is accessing public funds and having customer interface. Type 1 is just the exempted entity but has more than 1,000 crores of net worth, right? Now, in type 1 and type 2, obviously, you continue with the base, middle, upper layer. And upper layer, they've also changed it now. Upper layer earlier was just top 10 NBFCs. They would kind of keep categorizing it into the upper layer. Now they've said it's if you have more than 1 lakh crore worth of assets, you would be kind of treated as part of upper layer. So this is really the change that has happened from a compliance perspective from just categorization. The other big change that has happened, and that I think is a continuation of RBI's efforts from before, is once you are in the so-called upper layer or you are like a deposit taking NBFC, etc., they want to regulate you as much as possible like a bank, because they think you're systemically very important at this level. And therefore, like even from corporate governance standards, requirement of board oversight on multiple functions, mandatory compliance officer even at a middle layer NBFC, and the role of the compliance officer and compliance team is further expanded when you're in upper layer. So the governance standards and structure seems to be kind of, if you are such a big financial institution, you need to be regulated a little more differently, and therefore it's a little more strict. The other thing we understand is also from an RBI audit perspective, they plan to, if you're in the upper layer, kind of do those yearly audits in the same fashion how they would do with any other scheduled commercial bank today, right? That's the kind of oversight they also want to have. they are like multiple audits we've seen with our clients where they've kind of requested, like, why is the board not overseeing this function? Why are decisions being taken at an individual level? Why isn't it coming to a committee, etc., all of that? So I think a lot of things which we as NBFCs took for granted, I mean, essentially that is the way we grew, right? A lot of NBFCs grew because of the fact that we had that agility, we had that flexibility to take decisions, etc. But now, because some of them have grown so big, RBI is saying that, I mean, that level of agility may not be available anymore. It is some kind of a system where a committee or a board decides. So I think that is by and large the biggest changes we are seeing. Ankit, I'm hoping I've covered some ground. If you need me to expand on any of this, I'm happy to kind of.
So I'll just try picking one specific part. Just before I move to the next panel, I just wanted to iterate that to the audience that please drop in your question as and when they come to your thought, and we would definitely address those as and when the webinar progresses at the later stages. So Neha, taking from you where I understand that the architecture itself is now risk tired. Abhijit, on to you. If the structure change this fundamentally, capital planning can't stay backward, right? So how has SBR changed the way NBFC need to approach the capital planning? Is it now more forward looking than historical?
Sure. First of all, thank you, Ankit. Thank you, Sadaf, and thank you, Team Influence, for organizing this. Delighted to be here today. Looking forward to sharing our perspective and learning from my fellow panelists. Uh, so to answer your question, yes, definitely. But let me first tell you where I'm speaking from, or where I'm coming from. I run a base layer NBFC. So technically, ICAP doesn't, apply to me. However, being said that, I think SBR has changed how I think about capital, even without that formal requirement. So before SBR, capital planning was simple. You kept your CRAR at 15%, tier 1 at 10%, and that was it. You weren't really thinking ahead. You were just reporting a number. The transition to internal capital adequacy assessment shifts NBFC's capital from a rigid one size fits all kind of a regulatory formula to a highly tailored, forward-looking management framework. While traditional CRAR mandates a single backward-looking ratio based on the standard risk weights, ICAP requires NBFCs to internally assess the capital for all material risks. So here's what we have actually started doing at Unnati. Uh, what capital does the specific risk actually need, not just take 15% rule says. For example, we enter a new product line or we push for growth in a specific asset class. We now sit down and ask ourselves what could specifically go wrong, and not just look at our overall CRAR and assume that we are fine. So that's a very basic version of what ICAP asks middle layer and upper layer NBFC to do formally. Further, so to my honest answer, SBR has made planning more forward looking, even outside its strict mandate. I'd rather build that habit now, even when I'm a base layer NBFC, on my own terms, than scramble to build it the day I cross 1,000 crore mark.
Okay, so what I understand is capital is what you protect, and now I understand where Ganesh is coming from and what's his area of expertise. Risk and internal audit is how you protect it, right? The capital, and that role has been clearly rewritten. So my question to you, Ganesh, is how has the role of risk and internal audit fundamentally changed under SBR, and what is expected now that simply wasn't expected 2 years ago? Or maybe should we even more be forward looking that, okay, given the regulations have changed so much, should I be well capitalized the near term, or maybe is there any regulation change which are you expecting in the near future, and you kind of accommodate by it?
Thank you, Ankit. A warm welcome to all my fellow panelists and also people who have taken time out on a Saturday to attend this webinar. To answer your question, Ankit, the regulations have been evolving as both Nihas and Abhijit spoke over a period of time. With respect to risk management and internal audit, it is not that SBR has changed things overnight. There have been frameworks that have been coming up over a last decade or so, where right from asset classification norms, those changed. Thereafter, risk-based internal audit framework was brought in by the regulator even before SBR was introduced. In terms of governance, I think Neha spoke about the different types of NBFCs requiring different types of norms that are applicable. But in terms of middle layer and upper layer, in terms of who can be a director of a middle layer entity, what should be the maximum number of caps on independent directorships that an independent director can have within NBFC. So there is a cap of say 3 directorships of a middle layer or an upper layer NBFC. In terms of composition of the audit team, who can be a chief audit officer, who can be a chief compliance officer. These are also mandated that the NBFC should have a chief compliance officer in place. For NBFCs having asset size more than 5,000 crores, a CRO was made mandatory, which was not earlier mandated. So the regulator has been focusing on governance as a theme to ensure that the message right from the top is very clear. So right from board, compliance, risk, and internal audit, which are the control functions within the organization, how they need to be strong enough were implemented. Subsequently, also as part of the SBR framework, as Abhijit spoke earlier, ICAP was introduced. Now, ICAP is not only restricted to capital planning, it covers the entire dimension. So prior to even ICAP gains, expected credit loss was made mandatory because NBFCs have transitioned to Ind AS while banks continue under IGAP. So under Ind AS framework, NBFCs are required to provide for credit loss provisions under expected credit loss framework. Now, this itself requires, as against banks which continue to provide under prudential norms, the expected credit loss framework requires NBFCs to provide capital as per, classifying assets as stage 1, stage 2, and stage 3, and then calculating the probability of default for each of these assets that is again defined, and then applying a loss given default rate for these assets, and then arriving at what will be the credit loss. So these frameworks have evolved over a period of time. There are a lot of new regulations that are coming. Since a lot of NBFCs now use model risk for credit decisioning or for multiple areas, there are new notifications that are under discussion for having a structured framework for model risk management framework, which means that wherever NBFCs use a model to either do credit decisioning or for anything that will lead to a decision making, there the NBFC wants to have an independent board approved framework in place for evaluating how the model is built, what kind of model validations will happen, and how the use of AI could potentially lead to further risks for the organization. So anything that will have a use of AI ML models that would probably be used for decision making. There are new norms coming to actually, put a framework around how NBFCs needs to be responsible while executing those. So the entire framework for risk and audit it's not something that it has changed overnight, but it has been evolving. Risk-based internal audit framework was implemented sometime in 2022. This meant that even internal audit functions, which typically used to, not have a standard approach for selecting how they will audit which function, they were then required to put a framework on what is the inherent risk and the control framework within the organization, basis which they had to identify what will be the residual risk for every function. And the functions, those were classified as higher risk, were required higher audit frequencies. So these were the frameworks that have evolved over the last few years. I think it is something that has been more gradual, but at the same time, the regulatory intensity on these notifications has increased considerably.
Okay, so just moving on to the next question to Atharva. So just for the benefit of audience, I just wanted to highlight that this specific round was very much focused on how SBR as an entire structured kind of created a change to the domains where the panelists are expertise in that. Nihas had taken us through the SBR evolution. Abhijit had touch base upon the capital planning, if they have to, kind of reject that little bit on the basis of the SBR norms. And Ganesh had given us a, highlight on the specific internal audit functions and how these have changed depending upon the norms. So all this specific thing, Atharva, onto you has to be evidenced, right? So
Yeah.
my question is, which RBI returns under SBR are the most critical and from a regulatory scrutiny standpoint, and what are the key timelines an NBFC must never miss?
Okay. So thank you so much, Sadaf and Ankit, for the introduction. First, coming to your question. So let's start with the foundation with the returns applicable to NBFC. So as per the new scale-based introduction, which has been introduced, it works on more enhanced governance and regulatory requirements and the expectations the RBI is having from a NBFC. Coming to the reporting which are applicable to the NBFCs, the new scale-based regulation does state that the returns which are applicable to the NBFCs are as per the returns which are prescribed by the Department of Supervision. So all the NBFCs are required to follow the same, and there has not been much alteration to the reporting architecture. But just for the participants who are new to this NBFC space, I would just state the returns which are applicable to the NBFCs. These returns are applicable based on the assets that we have already discussed, and Ankit, you have covered the same, that the scale-based regulation, how NBFC grows and the returns get applicable. So the first return, which is a critical one, is the DNBS 02, which talks about the important financial parameters. Return which we have to file quarterly, and the reporting date is within 21 days from the reference date. So here reference date is the last date of the particular period. Say we are talking about a quarterly return. So for Jan to March, the reporting date would be 31st March. And within 21 days from this reference date, we have to file this return. Moving further is the DNBS 10, that's about the statutory auditor certificate. We have to file this return within 5 working days on finalization of the audit report. And we have to file it not later than 31st December of the same year. The next return is DNBS 13, which talks about the overseas investment. So if our NBFC has received any investment which is received from offshore units, then we have to report the same a quarterly return, which has to be filed within 21 days from the reference date. Now, these are the return which are the basic returns which are applicable to nearly all the NBFCs. But if the NBFC grows and the asset size reaches a threshold of 100 crore, either at group level or entity level, then we have two more returns which become applicable. That is DNBS 4A and DNBS 4B. So 4A talks about the short-term dynamic liquidity, quarterly return to be filed within 21 days from the reference date. And the next is the DNBS 4B, which talks about the structural liquidity and interest rate sensitivity. It is a monthly return which has to be filed within 15 days from the reference date. Now, what important here is that the classification or the applicability of these returns are not just one time. See, NBFC receives a certificate of registration, then it commences the business, and as the NBFC grows, there may be other returns which get applicable to the NBFC depending on the growth of the asset size or anything. So that has to be assessed periodically in order to make sure that the returns are being filed within time and the applicable returns which are required. At times it happens that it is not just the errors or the incorrect return which is filed, but it is just a missed return which becomes applicable at a later stage. So we just have to keep on tracking our net own fund, all these things to make sure that we are filing the returns which are applicable to us.
Lovely. Now, just out of the context, now I just would like to comment of my understanding that getting a license is definitely a difficult journey, but defending your license is even the more difficult part, I could believe. But given the regulatory changes happening, it's becoming very difficult for NBFCs to kind of start defending the license, given the recent RBI cancellations which we are coming across. Now, Now, there concludes the round one, where we have got a fair idea of how the SBR was evolved and how the specific domains of each panelist were kind of impacted and how they had to, move forward. Now, this specific round two would focus on that we have a framework, but how this framework has been implemented to the daily practice, right? So, on to you, Nihas. The first question would be that I wanted to understand, what does this three-layer framework? So it's very simple. I know it's a base, middle, and upper, right? But it's not as simple as it sounds. But what does it practically mean for an NBFC's day-to-day governance structure?
Thank you, Ankit. It's a very it's a question that's often asked. What changes for us when a regulation comes out? Like clients keep asking, right? And what has changed? It's not like we are not adopting best practices. It's not like we do not understand how credit and compliance and risk functions. But yeah, so I think, see, I think broad level is, what is the regulator expectation? Regulator is saying, if you're on the base layer, you continue as is, right? You're on the base layer. We do not really think that we need to focus too much on you. You can function within that framework. You're not kind of impacting the system in a significant way. So therefore, it's a light touch regulation. So therefore, you'll have your annual returns, you'll have all of those filings, your compliance with whatever provisioning, etc. All of that. So there's not too much over writing of regulations there. Whatever is standardly applicable for a financial institution, that's all they're expecting you. And they're also now, with the new regulation, they made a distinction also there. If you're less than 1,000 crores and not even customer interfacing and accessing public funds, you don't even register. So you don't even need a license. They've amended even the the RBI Act to ensure that under that 45I, which typically required a NBFC to be registered with RBI, this exception is coming out. So this amendment also, I think, from a statutory perspective, is coming. Now, once you get into the middle layer, regulation is a little more kind of focused now, because now so the RBI's mindset is, if someone has reached the middle layer, there's nothing which stops them from reaching upper layer in a period of time. And we've seen actually NBFCs, like if you look at the current classification, 1 lakh crore of assets, we've seen situations where 20,000 to 1 lakh did not take more than 3 years. In fact, RBI pointed out, when this whole digital lending thing came about, when it's really probably the biggest issue they had. In fact, if I'm not wrong, when that Navi issue came with RBI's problem was not that specifically Navi did something wrong. They couldn't understand how Navi grew that fast, right? So, and then they got into, like, did you have the correct kind of compliance functions, etc. So I think some of so at middle layer, they know that, okay, you've reached a particular size. Now to scale up is just a question of getting adequate capitalization, etc. All of that. So therefore, we want to kind of ensure some level of discipline is instilled, so that as and when you reach the upper layer, you are like, you're functioning more like a bank than a loosely framework kind of financial entity. The little more oversight, etc. All of that. So that is the approach at the middle layer. At the upper layer, pretty much what they're saying is, you're too big now. You have your flexibility to make decisions at a CEO level, at product head levels, all is tied down to either a board oversight or a compliance oversight or a risk oversight, right? And at middle layer itself, they're trying to kind of bring this discipline by saying, one, I need a compliance officer to be appointed. You cannot be a NBFC in the middle layer anymore without a compliance officer, right? The moment you move to an upper layer, they're also outlining what all the compliance officer is expected to do. So one important role what the compliance officer does, which is traditionally how the banks used to function, is that is the interface with RBI. RBI will always kind of deal with the compliance officer whenever it has kind of issues. So at the middle layer thing itself, they're trying to create a direct channel of communication between the financial institution and the regulator, so that the kind of understanding and review of whatever is happening at the NBFC kind of becomes stricter, right? Now, while this is, I mean, it's easy to say it has become a little more stricter. I'll go back to what Ganesh was saying in the first panel itself. On paper, it looks stricter between a base layer and a middle layer. But what the middle layer had to do, RBI has been working on it, I would say from 2016 onwards, right? So a lot of things that they're implementing, that is written out here, something that RBI in some form or the other has been trying to kind of implement for NBFCs across. I think just seeing how interconnected they are, and ultimately NBFC is largely being driven by bank funds even today, right? And therefore, if banks are significantly important and they are kind of being regulated in a particular manner, anyone who's accessing their funds in such a big manner, I think that is one requirement that we are seeing across the board. But the only point I want to make is, as far as middle layer NBFC is concerned, I don't think a lot of things are new. A lot of things have been kind of thing. I would say a compliance officer compulsory may be something that someone would say is new. But we knew RBI and audits, even before this was written on paper, used to go to NBFCs of particular size and say, why don't you have a compliance officer? They used to ask that. They're like, yeah, you all should also, I mean, we don't have to tell you everything, right? You all should know that at this size, you need someone of this nature because you are a financial institution. It is a function which is so important. So I think apart from this, I really don't have anything to add on the, key changes or additional regulations.
So just one question, a follow-up question. So for an example, an NBFC sets up and it definitely submits a business plan to the RBI, right? In the business plan, it mentions that my loan book will scale from say 50 crores to 150 to 200 to 500, right? At any given point of time, does the NBFC pre-plan on, kind of making sure that is it premature for them to, try implementing all those norms and regulations which might be applicable if they reach the middle layer, or should they just wait for that exact point when they reach the middle layer? So should they be better prepared, or should they prepare themselves when they reach that specific layer? Niyas.
The way I'd look at it, I mean, and this is what I've told a couple of clients who are trying to set up financial entities also is, see, at a base layer, if you also don't know how much this is going to scale,
Correct.
right? It is fine to take a little bit of a relaxed approach, right? But yes, if you yourself have a business plan or you have, say, you've taken money from external investors, right? Then they 100% want a pathway to growth, or they'll, like if it's a PE fund and all, they'll ask in 5-6 years, they want an exit, etc. All of that. To get an IPO of a company less than 1,000 crores asset size is going to be very difficult. So I'm saying, if you have commitments that, and you know that this is the only way forward, by all means be prepared. See what are best practices you can imbibe, etc. Anyhow, when you have external investors, I think a lot of things, even from a board control and like shareholder level activism increases a little bit when you have investors. But apart from that, if you have a clear-cut path to 1,000 crores, by all means start early. What is it's very difficult to imbibe compliance into people like at a customer facing level who are not used to it. It's very challenging to implement it. If you ask me, if someone was doing business a particular way, it becomes very challenging to kind of make them like kind of take. So therefore, if you are a base layer NBFC and you know that you're going to go to middle, by all means start early. But mostly what I've seen is at a base layer NBFC, we don't know where we are headed. So therefore, it's fine to till you have that clarity or that vision that this is where it is going. You may kind of take it easy because these are also expensive kind of habits to have, right? All said and done, it's not easy on the pockets at all.
So point well taken. So my next question would be to Abhijit, and just following up on what Nihas had mentioned, that when Navi grew exponentially, right? Even the regulators were so surprised that, boss, what has happened, right? So also quoting on the recent quarter results, but I'm not bringing the company's name. So I read about what the management told, that they won't be pursuing growth. Rather, they would look at the quality of the loan books and the quality of product which they want to pursue. The reason they told this commentary because market didn't pursue because results were not expected what the market was expecting. So sequentially they didn't grow, but year on year they grew. Correct. So management was very clear that I don't want to get into those products which my NIMs deteriorate. So my question to Abhijit is, what are the most practical challenges that an NBFC face in maintaining the required CRAR and simultaneously pursuing growth targets?
Yeah, so Ankit, this one's very real for me, growth and capital adequacy.
Correct.
We deal with this every day, not just on paper. The hard part isn't raising capital, it's that growth eats your capital buffer faster than your people expect. So every rupee we lend adds to our risk-weighted assets. Our profits don't grow as fast as our lending does. We have to regularly keep introducing or pumping in capital every now and then. And as you rightly mentioned about an organization or the management concurring that we would like to focus more on the NIMs instead of growing the book sequentially or on quarter basis. That's the same kind of approach we have in our organization as well, because at the end of the day you have to monitor what kind of NIMs or ROTA you are maintaining. So instead of just simply growing your book, it is pertinent that we maintain the margins. Okay. So now let me come back to what is the basic challenge we face in maintaining the CRAR in these dynamic times. So we are a gold focused NBFC. We run gold loans. We also do loan against property and small business loans. But so one peculiar challenge with being a gold loan NBFC is that so RBI hasn't asked the gold loan NBFCs to hold any extra capital. On paper, we are treated like any other secured lender, but we don't fully agree with that because gold loan repayments come in one lumps, or they are pretty bulky. Gold prices move up and down during the loan, and there's a seasonal pattern to when people redeem their loans. So even though we are not required to maintain an additional capital, we choose to hold more capital than what is required because we think the real risk is a bit higher than what the rule actually or the regulator actually assumes. So and I guess way back in 2023 RBI actually did something similar. They raised the risk weights on personal loans from 100% to 125% because delinquencies were rising. But the point is simple. RBI changed the number because the risk had changed. That the same we did not internally with other asset classes. So the other challenge was, for us was about the funding, not risk weight. We had a term loan with fixed repayments date, but our gold loan disbursements don't follow a fixed pattern. They are lumpy. So we are either holding money we weren't using or short at the wrong time. We built a cash flow model, showed our lender the benefit on their side too, and moved that facility from a term loan to an overdraft facility or a cash credit setup. Now we draw money only when we actually need it. So three things here. Uh, Hold extra capital where you think the real risk is higher than the rule says. What actually RBI adjust risk weights as the credit cycle changes, and fix your funding structure so your capital setting isn't idle or stretched at the wrong time.
Okay. So how do you address this ALM mismatches, Abhijit, as in?
Yeah, so it's quite difficult to manage our ALM because 70 or 75% of my balance sheet is concentrated in gold loans today,
Correct.
and as you know, the uncertainties in the cash flow or the you can't predict the gold loan cash flows as accurately as you do with other loan asset classes. So we have switched to raising or diversifying our funding sources. Instead of raising more term loans, we are focused on availing funds from the same banks via ODCC facilities, or even tapping the retail market by raising NCDs. So
Okay.
and in the NCD program, we usually have a lock-in period of 3 or 5 years, depending on the return on investment which we offer. So that really helps us to tie the ALM gap. And yeah, you also come recurringly on recurring basis. You also keep introducing capital, which again takes care of the uncertainties involved, or the ALM gap, which is there in the business.
Okay. Thank you, Abhijit. So, if I would say a framework is a framework unless implemented. So, coming to you, Ganesh, what should an NBFC internal audit universe cover under SBR? Are there any areas of inconsistency or consistently which is being missed?
So, if I were you, Ankit, I would probably ask, what is an area that could not be covered under audit?
Correct.
Because the regulator expects that everything under the sun should be covered by the internal audit in the company. There are specific notifications that mention that mandate internal audit to cover certain. For example, SBR, under SBR framework, internal audit is mandatorily required to audit both risk management and compliance functions. There are specific notifications that when we started, I think Nihas mentioned about transfer of loan exposures or securitization. There are specific notifications on co-lending. Their internal audit is specifically required to audit the frameworks. There are specific guidelines on internal ombudsman where internal audit is required. So that's with respect to customer grievances and customer service management. So increasingly, earlier, internal audit used to largely focus on areas of compliances or filing returns or areas of controls. Now the regulators don't seem to be very happy with internal audit only pointing out areas of potential failures of compliances or controls. They want internal audit to be more proactively engaged in preempting what could potentially go wrong. So the lines of difference between what the risk and compliance could do of preempting what are the potential risks that the company could have. The regulators now also expect internal audit to preempt whether risk is doing their job right or not. And then if there are risks that the risk department did not identify and provide for, it is expecting the audit teams to flag that off to the audit committee as well as to the board as to what are the risks that did not get covered by the risk department adequately. So the regulations currently require all the business activities and support functions to come under the umbrella of internal audit. Again, functions that are considered as higher risk require a higher audit frequency. But then within the cycle of one audit, where the regulator has suggested that it should not exceed 3 years, everything in the company should get audited. So all business functions, support functions, branches should get covered within that period. It's the regulatory expectation. Organizations have taken differential approaches in internal audit. For example, organization like mine audit everything much more frequently than probably an organization of our size and scale. But there are companies which are large enough which don't audit everything every year. They spread it out over 3 years, and they take high risk functions every year, medium risk functions maybe every 2 years, and so on. So I think there is nothing that is permitted to be kept outside the scope of internal audit, which falls under the area of control or compliance. So the definition of assurance is now provided by the regulator, which means that internal audit is an independent function that provides assurance to the board and the management on the effectiveness of compliances and controls implemented by the company. So anything that will fall within this definition of giving an assurance, independent assurance to the board and management will fall under the scope of audit. And it's a very, very large scope.
Maybe when you say whatever depends upon the definition, so who defines it? As in, does the management proactively decide that this aspect or processes also has to be brought under the scope of internal audit? Or
No, the requirement to set governance standard is kept at the board level, where board is required to oversee all the control functions.
okay,
Board is given the responsibility to ensure that the internal audit is adequately staffed and is equipped to carry out an independent assessment. So the onus of ensuring a strong internal audit function is kept with the board of the company.
understood.
Again, the definition of what is an assurance is given by the regulator. So the definition is not open to interpretation. Anything that tells the board or that will probably impede the auditor's capability to provide an independent assessment of the effectiveness of controls and compliance to the board needs to be flagged off by the internal auditor to the audit committee or the board. So the scale-based regulations also require that the internal auditor meets the audit committee minus the management, without the presence of the management. So there has to be a one-to-one meeting between the internal auditor and the audit committee without the presence of anyone in the management. These kind of frameworks were implemented by the regulator to ensure that the audit function maintains at all times independence and is also able to identify control weaknesses, compliance gaps across all functions. So the entire oversight of internal audits is with the audit committee and the board of the company.
Thanks, Ganesh. And just before I proceed to Atharva, Geeta, if you have any specific questions or thoughts, you could just use the chat box. We'll definitely address to it as and when we progress to the end of the session. I assure you that. And right now, on to you, Atharva. So, I believe that an NBFC has to consistently keep borrowing, right? To expand their business or the loan books. So the borrowings may be classified by private placement, or you're tapping the ECBs, external commercial borrowing. So when I consider the ambit of entire structure, so can you just walk me through the intersection of FEMA reporting, RBI reporting, and statutory reporting? And where do most NBFC often miss this overlap?
Okay, sure, Ankit. So now let's widen our lens. See, the RBI reporting doesn't come in isolation. It intersects with other reporting as well. So
Okay.
we'll just picturize a three-column diagram. The first one is for the RBI reporting, which are the periodic returns, which we file the DNBS returns. The second one is the FEMA compliances, and third we can take as the other statutory returns, the companies act, etc. So RBI reporting, I have discussed in previous question as well that the returns which are applicable, we are supposed to file this. The next one is the FEMA reporting. In the FEMA reporting, if we are touching any cross-border transactions, say any loan has been borrowed from offshore units, or we can say any equity allotment has been done, then the FEMA transactions get triggered. Coming to the Companies Act or other filings as well, in companies we do report the related party transaction in UC2 and all that has to be also be reconciled with the returns which we are filing, say the related party exposure which is filed for the NBFC. Moving further, we can say for the FEMA compliances as well, see the FCGPR and ECB, all these get triggered when we are entering into such transaction. Recently, in January, the RBI has amended I can say the tighten the regulations for the ECB and the end use of the ECB as well. And a new form which has been introduced, that is Form GRN for the guarantees, if any we have issued. So there is a chances of which was what we said, the overlap, since the treasury and the compliance sits apart. So that thing happens is the first. Moving to the company law compliances, the related party exposure has to be reported with the DNBS related party exposure as well. Then comes to the other statutory compliances, say the income tax. See, NBS is required to do the NPA classification, provisioning has to be done, return off has to be done. So that has also to be reconciled with the filings which we are doing on the income tax. And we can say that any statutory audit findings, say if the auditor qualifies our asset classification, so that has to be followed back in our return, which we are going to file. That should not just ideally sit in our financial statement only. So that has to be done. So the common thread here is that these all activity has been seen as a separate function or for separate heads. Now, where it should actually feed in is that someone has to reconcile this, that whatever we are filing are aligning with each other. So that is the first thing. So now why the overlaps are getting missed? Say the three transactions, one FEMA, RBI, and we can say companies act. So FEMA compliances are transaction triggered. So once we are entering into it, then it will get triggered. Say we have allotted the equity or something like this. On the other hand, the RBI compliances and reporting are period specific, like quarterly, monthly, biannual, annual. That's it. And the last is the comparison transaction. They are also say annual, say we can say the annual filing and all. So we can say a same transaction with three different timings. So that is what it gets difficult for NBFC to miss the overlap. We can take the, I mean, just take two examples, say the FLA return versus the auditor financials. It's July 15 almost, and the companies are the applicable companies are supposed to file the FLA return. So the annotated figures which we are filing, post that the audit takes place in the month of say late August or September. So at times it has been observed that the figures in the provisional FLA does not match with the audited figures. So we have to make sure that reconcile the same with the audited figures. Coming to the NF competition and the lagging, I can say the FCGPR. See, your NF drives your CRAR, and your NOF is basically the thing which can identify that where the NBFC stands, the layer of the NBFC, how much we can basically lend to the other lenders. And the NOF includes the foreign equities as well. So in case if there is an FCGPR which has been late filed, or we can say a off valuation, then the NOF certificate which has been issued by the statutory auditor, it would be technically wrong, although in books it might look fine. So these are few examples where there happens a mismatch, or we can say the overlap take place.
Okay. So there we conclude the round two, as in again iterating the round one was the evolution and how the domains were kind of iterated and they had to reject their way of functioning. Round two was the framework getting implemented into the day-to-day practices. So once all this is done, someone has to be accountable, right? So that's where we go to the round three, that who owns the outcome and the failure points that keep resurfacing across the NBFCs. Again, on to you, Nihas. So the master direction places significant responsibility on the board. What specific accountability expectations have changed, and how should board recalibrate their oversight role?
Thank you. Thank you. So I think the theme that runs through any financial institution is the RBI is very, very invested in how actively involved the board is in decision making, etc. We have seen instances of RBI holding up approvals on other matters until some changes have been done on the board or some key management personnel have been replaced, etc. So from an RBI standpoint and from a regulator standpoint, and just from the financial ecosystem, right? I think RBI wants the board to play a very, very active role, not a hands-off approach saying the management has been doing so well, why should we interfere in their decisions, right? So in fact, this is the kind of questions most of the clients get, is that how is the board satisfied with certain decisions that are being made? Like, I think Ganesh also alluded to this, where the the board has to ultimately decide how to be satisfied that there was a compliance function overlooking this, or there was an audit of these kind of functions, etc. All of that, right? Here we are talking about a situation where we are seeing frauds increase at a very, very significant level. We are seeing bad players in a system being able to manipulate the system. So I think from that perspective, they have kind of align the regulations to ensure ultimate responsibilities of the board. The board cannot say someone else was doing it. This is primary thing. Specifically, what have they asked at the end of the day for the board to do? Is board has to now ensure that policies are there in place for anything to do with your employees, right? So who do you get into senior management? You have to have a fit and proper policy. This is completely board governed, board aligned, right? What board has to outline the role of the compliance officer. Board has to ensure that the compliance officer is discharging those functions. Board has to ensure like even the compensation policy of the company is in line with where the company is at. We've seen RBI asking questions on why did you decide the policy in this manner? Why are these incentives not linked to certain other parameters also as opposed to just growth, right? And obviously from the audit functions, the accounting functions, all of that, they want to ensure that board has complete oversight. So now one is you have to put in place the policy. Two, you have to establish to the regulator or at least internally to your auditor, how did you discharge that oversight? Just by putting in a policy is not enough, right? Then multiple board members are expected to be on the key committees, right? Whether it's your risk management committee, audit committee, nomination, remuneration, NRC, right? Board members are expected to be there. They're expected to kind of have an active role. And we've seen situations where in compliance, a board will delegate to a committee. They forget the fact that the board has to take note of everything that the committee has done. The board has to approve it at a subsequent board meeting. We've seen the regulator haul up companies saying that, why aren't you kind of discharge? And these are all not RBI driven also. This is actually original Companies Act provisions in relation to how. But RBI is looking at that because RBI is saying just because you constituted a committee does not mean that you do not look at what they've done and what are the decisions that they kind of. Then I think just general, from an instance perspective, what we saw was the decision on management remuneration. They were like, see, the regulator's concern was you're not linking it to what you have observed from a compliance perspective or processes perspective, adherences to processes, etc. All of that. You're simply looking at it only from a revenue perspective. And they want us to analyze. They want the board to be actively involved in not just growth from a number perspective, growth from even a process perspective, adherences to processes, etc. They have requested in the past for certain changes on the basis that, this person, while growth is coming across, does not seem to be listening to the board, right? In financial institutions, more and more we are seeing that they do not like management who are pretty much kind of overbearing on the board, right? I mean, too big a personality. And so now at banks, it's very, very normal for RBI to insist on that. We are seeing that now even at NBFC level where they're asking these kind of questions. So therefore, the expectation is that board members are kind of very, very much more active in the whole adherence process also. Not just laying down a policy, it also ensure compliance with policy.
So if I could kind of sum it up, accountability is tested most when something is hard to get. So Abhijit, on to you, where my next question lies, that from inside Unnati, where did the real difficulty sit? As in from your experience in implementing the norms, prudential norm at Unnati FinServ, what was the single hardest challenge and how did you even try to resolve it?
So honestly, Ankit, I would want to answer this a little differently than you would expect me to. A lot
Okay.
of these prudential norms weren't really a challenge for us because we were already following them before RBI made them mandatory. Let me give you a few examples and then tell you what the real challenge actually was. On the capital front, we have always run between a CRAR or CRAR between 25% to 35%, which is way higher than the 15% floor. On the NPA front, we have always sticked to recognizing the asset at 90 DPD. for the last 5 years now, well before it was uniform across all NBFCs. As far as the income recognition goes, once an account becomes an NPA, we stop accruing income and book it only on cash receipt basis. And this is what exactly RBI expect us to have, and we just never did it any other way. And on exposure, we have capped ourselves at 5% of our net worth, or 5% of my total capital and the free reserves which we have per borrower since the day we started. Well before RBI made a concentration policy mandatory for base layer NBFCs in January 24. So all of these, I don't want to sit here and pretend that we struggle, but these were part of how we run the business from day one, not something we adopted after RBI mandated us to. The one challenge which we faced was, if I had to point, was the technology to implement all of these, the real-time NPA tracking, the provision calculation. Earlier, we had an approach to calculate all these functions manually. However, we have been investing a lot in automation to calculate all these numbers automatically, instead of doing it in a manual basis. So, but again, that's a continuous journey for a base layer NBFC, or even for that matter for any other NBFC. And it's not only and it's only we are actively investing in it, because good governance isn't a good one-time build. It's something you keep upgrading. So yeah, my honest answer is the norms themselves were never a challenge or a struggle for us, because they were already part of our ecosystem or how we operate. The real ongoing work is making sure our systems and technology keep pace with that discipline as we scale. I guess, Ankit,
You're on mute.
you're on mute.
Am I audible? So
Yeah.
I've understood this. So I think that an event occurs and RBI becomes proactive, and then RBI implements and learns from the situation and tries implementing all these norms, right? So coming to you, Ganesh, where you cover the risk, internal controls, and audit readiness, what are the most recurring control weaknesses which keeps persisting, right, and repeatedly comes up in internal audits which you have done? And why do they keep recurring on and on? As in, why there's no end to it? As in, I just wanted to understand from your lens.
Uh, I'll answer this in two parts.
Okay.
One is, that could be controls which are manual in process. Currently, I think Abhijit spoke earlier about automating probably the daily DPD monitoring that he just recently spoke, that, so things that were in Excel sheet before. For example, if you're doing a loan transaction, there may be certain policy deviations that you may have mentioned in the credit policy. Now, some of these policy deviations may be automated in your loan origination system. Some of these policy deviation marking, identifying these policy deviations may be a physical activity done by the credit teams. Now, wherever there are manual tasks involved, there are bound to be errors in adherence to the policy, because every time you have a human element to any task, human beings are prone to making errors. So there will be control gaps that you will get. That will come as repeated areas of incident. So how management typically addresses those is by training those credit employees. But then, again, for example, an area in customer service where the classification of a ticket, of query, request, or complaint as query, request, or complaint has some amount of subjectivity, because a person who is actually receiving the service ticket from a customer may not know whether it was a query, or may think that it was a request, but then the customer may be really irate and he may think that it is a complaint. Any area which is prone to manual activity will have areas of repeat instances where the management needs to ensure that they automate the control process, because This is an area that the regulators don't like, and they consider any instance of repeat audit observation as weak compliance culture. So it comes in, the regulator gives the regulatory inspection reports in multiple sections or multiple reports. Within the regulatory inspection, every inspection will have multiple reports. It will not be one report of RBI. So there is a report called risk assessment report, which is called RAR in NBFCs. So the RAR has got specific sections for compliance, internal audit, for risk department, and for all the others. So RBI typically uses a camel's approach for the regulatory inspection. So in the RAR report, regulators are very, very likely. So wherever there are internal audit observations which have repeat observations, or where non-sustenance to earlier compliance observations or earlier regulatory inspection observations were found, they will normally call this in the compliance function weakness, as this meant that the compliance culture was weak. So this is one observation that normally comes in the compliance functions observation, that repeated internal audit observations or non-sustenance of regulatory inspection points indicated a repeated, compliance culture, or weak compliance culture. Again, there may be areas where the board is held accountable. So in case there are repeated audit observations, and if the repeat observations are relating to high risk observation, then instead of penalizing the function or the audit function or the risk function or the compliance function, regulators typically put the onus on board, saying that the audit committee did not ensure that controls were adequately implemented for high risk function, and there continued to be repeated observations on these areas. So this is an area where instead of penalizing the management, regulators find an easier target to directly hit the board, to say that the board did not ensure that the controls were implemented. Another point, the board again will give an instruction to the audit team that if you feel that the controls have not got implemented, then why did you close the audit observation in the first place? Because every audit observation needs to be also closed for the management actions implemented. So an audit observation which was closed and thereafter you had a repeat observation, meaning the closure was incorrect in the first place. So the audit committee will try to take an alibi कि तुमने फिर close क्यों किया if you found that the controls were not implemented. So it's something that can get into a loop. But then, this is something that is a very classic, usual thing in a NBFC. Normally, the journey is from having manual controls automated, and then a reduction in the number of instances that you will see that are repeating, and then calibrating each and every process. So companies, as NBFC scale, they have to constantly invest in, so there is not only investing for business growth, the cost of compliance become a very, very expensive task for normally NBFCs to scale. So there is a substantial investment that goes towards complying with the existing frameworks, and cost of compliance is also very high. So NBFCs that need to scale also needs to have significant budget for automating several controls, which they may have not envisaged, because this is not something that is directly linked to business. But then normally the growth of an NBFC has got cycles. So it starts with very high governance standards. I think earlier you asked Abhijit on how do they raise capital. The foundation for raising capital is governance, because if you don't have very high governance, you cannot raise capital. And unless you raise capital, you cannot scale up. So governance is something that, repeat observations is an area where people can reduce repeat observations through automating processes. So putting standard operating processes in place, because if you don't have SOPs, if you don't have policy frameworks in place, then there are likely that the last mile resources who are executing it on the ground will not follow the standard processes, and they are likely to breach. So to reduce manual activity, automation is one. And second, you could again put SOPs and policies in place, which means that the last mile again understand, and that could be reinforced through training. Sorry for a long answer.
No, well, it was, well, very much enlightening. So on to you, Atharva. So as Ganesh had pointed out, the recurring weaknesses and how the board is very much proactive and they try to kind of address it. So what are the most frequent reporting errors which you foresee across NBFCs and are there any patterns where the mistakes happen?
Okay, so basically there are five areas which I would like to highlight over here. We'll start with the first one. The first one is for the mismatch in the balances. See, what basically happens is that once the reporting period starts, the 21 days which we discussed previously, so NBFCs are supposed to file their return in this period. So as per the data which has been given, what we can say by the treasury team, we are supposed to file this return based on it. So at times it happens that the details which are required in the return are not exactly covered in the same manner as reported in the data or provided by the data by the treasury teams. So it does happen to just because once we are filing the return, it asks for the errors because once the report has completed, we have to validate this return and then we can file the same. So at times it has been observed that the uh, people who are filing this return, what will basically do that they will just enter the details just for the sake of tallying the return or we can say validating the return. So this is the first thing which has been observed. And the next is the classification. So RBI master direction and RBI has given a prescribed what I can say the walk through how a asset or a lender has to be categorized, the classification, when it can be termed as a standard asset, substandard asset, non-performing asset. It has everything has been prescribed by RBI. So this has to be checked by NBFC. Even the provisioning as well, that when an asset has to be provisioned, the provision in case any government relief has been received from NBFC, what has to be done. These are things which NBFC shall take care of. The next two returns are basically some clerical things. That is the wrong format, I can say, of the return. Since the portal has been changing significantly from RBI. Previously, it was different portal. The taxonomies also get changed. So we have to make sure that we are following the correct taxonomy and the right return. The next one is the last minute or the late filing of the return. So if we are filing the return late or say at the last minute, then it becomes issue because there is less room for the review. The last one is a single ownership. The same person preparing the return, reviewing the return, and filing the same. This has been observed in a lot of the cases. Even the fifth point, that is the single ownership. RBI do stress on this thing in case of inspection that whether there are a maker checker in the NBFC. Now, the maker checker shall not be just in case of transaction. The same has to be there in compliance and reporting as well. That one person is preparing the same, the other one has been keeping a track that the file return has been correctly filed or not. So that is the one thing, Adha.
Okay, thanks, Atharva. So there we conclude the round three where the accountability part, is very much clear. Now on to the round four where we are sure that how the evolution happened and how the framework gets implemented, and once the framework gets implemented, who takes the accountability of it. Now, because when we say business is perpetual, right? So we have to keep evolving, keep we as an NBFC or the ecosystem I'm in, I have to make sure that I just keep growing, growing, growing because there's so much of market opportunity. So again, on to new Nihas. My first question is, so building forward, what key decisions should a board be taking today, right now, to ensure that they are future ready under the SBR or also being very proactive, maybe next 3-4 years looking at what the West has implemented and likes of credits use happening, maybe or may not be. We might see this failures in India as well. So, how proactive should the board be and prepared?
Thank you, Ankit. Very, very expensive question. But see, I think the key, as we've been, I think all the panelists repeatedly we've been saying, is that people and processes matter, right? So I think future ready, that's your key word. Now, like simple things, what we've seen with multiple NBFCs is you have a compliance function, and that compliance function ends up doing legal, regulatory, and actual corporate secretarial work also, right?
Correct.
Now, if you look at today's compliance requirements, legal requirements, or regulatory requirements, I don't think it's a single function anymore, right? It has or you staff it adequately. I mean, whichever way you want to go, right? You then call a compliance function which is as big as your sales team. I don't know. So essentially, you have to have dedicated people for dedicated roles. You're talking about like things like a technology officer, and now with data privacy laws being threatened to be implemented in India, I mean, to read that law, I think you need one person and then another person to implement it, right? And data privacy officers are it's so much in demand. The courses are being kind of sold out in seconds of launching, and the requirement and the kind of poaching we are seeing at some of the bigger entities on data privacy officers significant. Obviously, human resources cannot be ignored. Uh, so people and persons is everyone's kind of goal to be future ready. Because unless you, it, I don't think in today's day and age a financial institution can run with 3 people at senior management anymore. Your senior management will need to expand. You will need to have this level of inputs from so many people. And obviously, as you can see, once you reach the middle layer itself, there's a requirement to have independent directors because that's the only way you can have your NRCs, etc., all of that. So finding people who are aligned in some way to your vision, but also gives you that stabilizing factor which can help you grow as you move forward, right? So people, this is the way I look at it. Roles are not what it was 20 years ago. And even with all of this, I still don't think we will reach like a financial institution model or a capability at even a European standard or American standard because their processes is one tested over like more than centuries, and they've created those, and it's inbuilt into them. Like uh, I don't think today like a German financial organization even thinks twice about having a legal department, right? So, so I don't think we'll reach there immediately, but that is a way to grow, right? That is 100% processes, which I think we've kind of outlined, and I think as some of previous panelists said also, given where we have the technology, you have to try and see how much of this can be automated. So it cannot be subject to human error anymore. Like one thing we are seeing across, I think, in the West in a big way is suddenly they've realized that people can influence the accounting system in such a way. They found errors and double selling, which is basically my loan asset. I've sold it, I've either mortgaged it to one person and sold it to another, or mortgaged it to 2 people, right? Now, this is an advanced system where such an error got discovered. So therefore, I think automation and the lack of human intervention is where we will obviously see less scope for human intervention and fraud, etc., all of that. Obviously, that also means that you have to double check and triple check the system itself to see if that technology is what it says it is. We have seen instances of people trying to sell tech products to financial institutions which have backdoor accesses, etc., all of that. So it becomes important for, I think, anyone who's a promoter or anyone who's involved in senior management to kind of ensure that their processes or for even like engaging with a particular technology or identifying a particular process, etc., is much more involved because the foundation of a financial institution is trust, and any one breach is all that it takes. So I think people and processes is how I conclude it.
So if I would sum this up, what Abhijit had to just say and what I've understood, that the board sets the governance and process, right? And once that's done, so moving to Abhijit. So, of my understanding, how the entire landscape has changed, where the banking division was a bit anti-lending to NBFCs, given the higher risk-weighted asset classification then, because post ILNFS and DHFL, and then RBI coming, stepping in, and making sure that everything falls in place and order. And right now, banks have become very proactive in lending NBFCs right now, and they have also been a little lenient to the banks, right? So, how do you project capital planning for the next 2, 3 year horizon? Given there's a bit of uncertainty in credit costs because majorly it's all macro driven, not micro driven, of what's happening in the West, and the yield is coming out, and it's a functioning of rupee movement. I'm not getting into there, but what's your understanding that how one should plan the capital given there's uncertainty in the credit cost, and also regulatory changes is always which comes, it's not asked for.
Yeah, so Ankit, let me walk you through our approach. We basically have three scenarios. We build three scenarios, and I like to call them as a blue sky, gray sky, and black swan event. So in blue sky, everything is merrier, going right. The growth is on track. The credit costs are in check. No surprises. And the gray sky scenario, it is a more demanding environment wherein slower growth or the delinquencies are on the rise and tighter funding or liquidity issues. And the black swan is the scenario nobody sees coming until it arrives. So we take that scenario seriously, not because we are worried, but because we have been tested before and we came through stronger. As you rightly mentioned, in 2018, the IL&FS crisis reshaped how the entire NBFC sector thought about liquidity. Funding assumptions that everyone had in their mind or had taken for granted were tested overnight. Then in 2020, COVID tested every retail-focused NBFC's ability to adapt and in real time, ability to adapt in real time, the collections, the cash flows, everything had to be built on the fly. What I'm proud to say that we came through both of these periods, and we didn't just survive them, but we used them to sharpen how we plan. Every NBFC that has been through these cycles either got stronger or didn't make it. uh, so I believe even Ganesh would concur how difficult the IL&FS and COVID times were. But again, that experience is exactly why we run our capital the way we do today. We hold well above the minimum CRAR. As I mentioned earlier, we always target for a 25% or a 35% kind of a range. But because we know capital is what gives us options when the environment shifts, and we deliberate about our mixed on the secured and unsecured lending, because a well balanced book is what lets you have a steady and keep lending even when conditions are volatile or not favorable. That's a strength we have built intentionally, not something we back into an accident. So my honest answer for the next 2, 3 years is this: we plan for all these three scenarios, not because we expect the worst, but because we have been through these cycles before, and we know exactly how to come out ahead of them. That's the confidence our track record gives us, and it's exactly why we run a conservative, well capitalized balance sheet today.
Thank you, Abhijit. As in, of course, experiences definitely help you way forward and also being proactive. That's why these frameworks help one navigate all the difficulties. Ganesh, on to you. What are the top 5 things an NBFC should review and fix before its next RBI inspection?
So RBI has uses the camel's approach for inspection. So you can actually Google it. They focus on
Yeah.
6 areas on capital adequacy, asset quality, management, earnings, liquidity, and sensitivity. So RBI is extremely concerned about 4 things these days. One is whether NBFCs are using responsible financial innovation.
Hmm.
Second is on accountable conduct. So Do the management operate with accountability? Is there responsible governance in the organization? So are the governance frameworks ensuring responsibility across all the layers? And the fourth is customer centricity. So regulator has always focused on customer protection and customer centrality. So these are four things that the regulators will always focus on. So from this, several other notifications came. One was on fair practice. So some of the areas that regulators doggedly check in every inspection is fair practice code compliance, KYC compliance, third-party risks, which is outsourcing. What kind of frameworks, in case you're using material outsourcing, what kind of material outsourcing frameworks are you running? In terms of liquidity risk management, are you carrying adequate liquidity buffers? I think Abhijit spoke about asset liability mismatches in the past. It's a favorite area, not only from the point of view of whether management is managing liquidity risk very well. The expectation is that the internal auditors should also look at the components that go into asset liability risk management as to, from where each component that you reported in ALM statement and your structural liquidity statement, from where in the system is that coming, and is it system generated or is it manually calculated? Because the maturity buckets are largely arrive based on behavioral tenure and not contractual tenure. So if you have a loan of say 15 years, the maturity bucket of those loans is based on behavioral tenure and not contractual tenure. So there is a lot of management interpretation that goes into arriving at behavioral tenure of loans. So is that statistically validated? So regulators have got into every area, right from expected credit loss to ICAP, to treasury risk management, to liquidity risk management, to management efficacy. How fast are you growing? Growth rates is an area that is a favorite topic of regulators. And because if they see you growing very fast, they are likely, and especially if you're in an unsecured business class, they are likely to knock at your doors more often than you would expect. So few things that NBFCs can prepare is to do a gap assessment of what all notifications came in the last couple of years. Because if you are getting inspected every year, then most of the notifications that came prior to 2 years, you would have already got tested on. So whatever came in the last 2 years, NBFCs must do a gap assessment before the start of the regulatory inspection. They must look at their fair practice code areas, which means that customer service is an area that NBFCs have to focus on, because there is a tool that the regulator uses as a hearing tool for identifying all the control weaknesses that can be there that affect the customer. So customer service is a thing that the regulator has been particularly extremely focused on in regulatory inspection these days. So I think keeping these areas clean would mean that you are very well prepared for regulatory inspection.
Thank you, Ganesh. And now moving to the last and final round, where this is a bit deviated, but we are just trying to cover because of the evolution the digital lending landscape has, seen a rise. And it was of interest of, most of the people we tried interacting with, and what session, what topic should we cover. So firstly, onto you, Neha. So when we talk on general credit policies, right? So from a governance standpoint, what board level policies and oversight mechanism should an NBFC have specifically for its digital lending operations, and how different and distinct are they from the general credit policies?
No, thank you, Ankit. I think very topical question. I think, see, digital lending is still lending. So therefore, really, if you ask me from a process perspective or a policy perspective, the key thing is still how do you analyze your credit process, etc. All of that, right? But RBI understanding how the digital lending landscape is evolving, etc., have requested that you have to have certain kind of additional policies in place, especially where you're using intermediaries. You don't have your own capabilities, right? So if you're using like a loan service provider, then what is your policy for due diligence of the loan service provider? You have to have a policy for monitoring the portfolios originated by that loan service provider. Then just generally on your own digital lending platform itself, because there's no touch and feel of the customer anymore. They want you to have a policy for determining what, like on this journey, how are you determining the creditworthiness of the customer? Because it's not like you can physically make an assessment of whether this person is well off, this person has some kind of standing, etc. All of that vis-a-vis. So how is that, like, how do you take a typical physical process and kind of outline it on a digital platform? What is your process for that? Then what is your policy on execution of documents, storage of evidence? Because one of the key things on digital lending now is, because you don't have physical documents, if tomorrow there's a default, when you have to enforce it, the process for establishing that this agreement was executed between you and the customer now has an added layer where you have to get a certificate under what was earlier the 66A of the Information Technology Act, which basically is authentication of the communication between you and the customer, which accepted these terms and conditions, right? So you need to have a policy which outlines how you will execute your documents on this digital format, and how this will kind of be, how records will be maintained for the purpose of, whether it's for the purpose of evidence or whether it's the purpose of RBI compliance, right? Then storage is a big thing for them. Digitally signed documents still has to be stored. So where is it stored? Who has access to it is still an issue. Then I think the policy on grievance redressal, they are finding more and more issues with digital lending. So they're like, you need to have a specific, while you have a regular grievance redressal mechanism, how are we creating it separately for the digital lending platform is also something that we've seen the regulator ask. Then I think the key thing, which is again connected somewhere to data protection, and that is all this customer data, personal information that you're getting. How are you ensuring it's, one, not subject to any kind of breach, abuse, or two, that you do not use it other than for the purposes of kind of making available the loan or the product or kind of repaying, etc. So that they want you to have a policy on it. And obviously, once data protection, the rules are implemented, then obviously you have to comply with that additionally. But right now, they're just asking digital lending product providers to also ensure that they have a policy. And then if, like, you're giving a default loss guarantee or something, or you're taking a default loss guarantee, you want you to have a policy on what are the parameters on the basis of which this DLG will be kind of taken. Now, this is broadly what they're expecting from a policy perspective. But what we need to keep in mind is RBI itself is finding it very challenging to keep up pace with what is happening on the digital lending space. They themselves are learning. There are things that they have walked back on after trying to implement. We have a new situation now where increasingly we are seeing a large number of fraud cases where someone is doing the entire digital KYC, but they don't even know. Like a 70-year-old man is doing a digital KYC, but his nephew or someone is the one who's actually doing everything, putting in wrong bank account details. Now, from a financial institution perspective, there's no way to verify this. This then, after the loan, some 6 EMIs have come, 7th EMI has not come, you send a notice. That is when suddenly, a claim is being made. We've had situations where financial institutions, senior officers were dragged to police station, like they were summoned. And then we had to go and explain to them that we are not party to the fraud, right? I mean, this is what we have done. So I think this is an evolving kind of regulatory space. Everyone needs to keep a watch out. It's still lending, right? It is really the additional compliances is, how do you work this in a digital framework? Are you comfortable with it? A lot of us have started our careers in a physical space, whether it's loan compliance departments, legal departments, or sales departments, so suddenly now to a digital format, what are the changes we ourselves are kind of adapting? So I think those are the kind of challenges that are there, but list of policies are more or less aligned with ensuring that the digital process does not shortchange you on your regular underwriting process or customer protection processes.
Understood. So I guess we are close to 15 minutes, just being mindful of the time so that when I go to the next second last question on Abhijit, that digital lending portfolios tend to have different risk and delinquencies, right? It's out of my experience where we had interacted with an NBFC based out of Ahmedabad. So they had a bullet repayment ranging from 1 day to 45 days. Okay. So there's a person who pays in 10 days, and then once he doesn't pay in 10 days, then the DPD period starts. So their borrower base was close to 3 lakhs. So accounting DPD for all the 3 lakh people, it was so complex that what I'm trying to say here is because they tend to have different risk and delinquencies compared to traditional lending. How does this reflect in NBFC's capital planning and stress testing under ICAP? Abhijit, you're on mute. Yeah.
So let me answer this from how we actually think about digital lending. And since ICAP doesn't formally apply to us at the base layer, but yeah, digital loans are you highly unsecured loans, and the tenure is ultra short, anywhere between, as you mentioned, between 7 days to 360 days. So the risks shows up in days, not even in months. So here's the real problem. If you have a 90 or a say 30-day loan, you can't wait for 90 days to recognize or to call it
Correct.
as an NPA. By then, the loan is already over. The usual 90-day rule just doesn't fit such a short product. So for the digital lending asset class, we think the right approach is to borrow from ICAP thinking even informally and set provisioning based on what or how that specific product actually behaves, not a fixed design for a regular loan. So this applies to provisioning too. RBI's standard rule is 10% provisioning once a loan turns substandard. That works well for a regular loan with monthly repayment, but digital lending is a different animal. The entire loan amount is repaid in one shot at the end. Once a bullet loan crosses its due date, in our view, 10% is too tight or too low. We believe that it's more prudent to either write it off from your balance sheet. I was hearing what Atharva had earlier mentioned, that it makes sense to write it off from the balance sheet instead of providing 10% or
Provisions.
whatever 50% of the outstanding amount from a taxation point of view. But if it's later recovered, the amount can simply be added back as an income.
Other income.
Yeah, so it makes practical sense too, not just a risk management one. But the core point is a bullet loan either performs or it doesn't. Uh, there are only two ways about it, and no, there's very little in between. So the provisioning should reflect that reality, not a formal built for a different kind of loan. We should also be honest, digital lending is usually the highest risk part of an NBFC's book. Unsecured, fast disbursals, lighter checks by design. It needs its own planning, not the same treatment as secured lending. Yeah, and as Nihas earlier mentioned, he also mentioned about an incident where the loan was being applied through a KYC of a 70-year-old, and the nephew was the one who was monitoring it. We have faced that, but we were very quick to resolve those issues, and it was identified way before the disbursement had happened, and then my tech team was quick enough to have checks and balances in place to avoid such incidences in the future. But again, yes, that incident taught us a lot, and we have ensured that all those gaps have been plugged in. So my view on all of this is very simple. For a product like digital lending, which didn't really exist when a lot of prudential norms were first written, we believe in following the norms in spirit, not just the letter. The intent behind provisioning is to reflect real risk. And for bullet loans, that sometimes going well beyond what the rule technically asks us to do.
Okay. Thanks, Abhijit. Ganesh, on to you. Maybe if you could conclude in the next 3 minutes so that we could take up the last three questions, the questions next 5 minutes, and then we can conclude the webinar. What are the key audit risks specifically to digital lending, where I would say algorithm bias, data privacy, LSP dependency, fraud, and how does the internal audit coverage be designed to address these? I know it won't justify, 3 minutes won't justify, but you could throw a light on it.
So one is customer identification. As you know, both Nihas and Abhijit mentioned, most digital lending processes involve a VSIP-based customer identification process,
Mm-hmm.
where probably people use technology to do the KYC. Many times it so happens that the customers may actually use fake documents or fake probably KYC documents of someone else to apply for a loan. So typically, the VSIP infrastructure should have face match checks built in that gives how much percentage of face match actually exists and what was the liveliness check of the customer. So if the customer face match does not happen, but still you go ahead and disburse the loan, the regulators typically then ask, why did you not have specific policy parameters on having a specific face match percentage? आपको दिख रहा है 20% face match है, फिर भी आपने करने दिया, so why did you allow fraud to happen? Second is on using the correct credit methodology. So regulators don't like only a bureau-based methodology. They actually want to also check whether the borrower has the capability to repay the loan or not, and whether that was assessed or not. So bureau score or a high bureau score is not a pre-approved basis for giving a loan for a digital lending, because the regulators say if the borrower says that he does not have the capability to repay the loan, then how did you assess his capability? Third is the digital lending guidelines stipulate technology requirements, who you can disburse to, who the repayments should come from. So the disbursements should be made either to the borrower or to the ultimate beneficiary. It should not be made to a loan service provider or a digital lending partner. Again, the repayment should come directly from the customer. It should not be routed through the digital lending partner. So there are a lot of digital lending guidelines around this, and they become very, very pertinent. In terms of fraud, I think, as I mentioned earlier, majority of the digital lending frauds occur because people use fraudulent documents. You may get an Aadhaar and you may get a PAN card from somewhere, and that PAN card and Aadhaar gets misused. Technology should be leveraged because there are multiple players that are capable of validating the PAN card and Aadhaar today through digital channels. There is a DigiLocker verification available. There is a PAN card verification available. These technology could be leveraged to actually reduce fraud. The problems in digital lending is also that it's a small ticket, low value, high volume transaction. So normally regulators also get bombarded with number of complaints coming from the digital lending segment. So while your main segments could actually be translating into a less than 1% complaint, the digital lending space could actually land at the regulators. There may be multiple RBI escalations that may happen that may make the regulator feel very, very uncomfortable. So it's an area that can be grown, but the controls need to be very, very strongly defined and calibrated.
Thank you, Ganesh. And on to you, Sadaf. You could just take these three questions and I hand over to you right now.
Thank you, Ankit, and thank you to all our esteemed speakers for sharing such insightful perspectives on the SBR framework. With that, we will now move into the Q&A section. So we encourage the participants to submit their questions to the Q&A box or chat window. We will try to address as many questions. So there are three questions which we currently have. Any of our panelists can take it up. So the first question is from Mr. Abed, where he asks that for a base layer NBFC, ICC, which is currently dormant and wishes to start lending, can it start lending with net owned funds less than 5 crores?
Atharva, maybe you can take it.
Yeah.
Yeah, so basically the RBI and the Master Direction has provided the net owned fund criteria for NBFC, which they are supposed to follow. The scale-based regulation also states the same. And it has been also that the RBI has been strict towards the rate on fund. Previously, it was 2 crore, then it went to 5 crore, and currently they have raised to the 10 crore. So, as of my opinion, I don't think so that the NBFC with NF of less than 5 crore can start its lending activities.
Okay. We move on to the next question, which is from Priyanka, where she has asked that apart from the DNBS 10 statutory auditor certificate, are there any other mandatory auditor certifications required for NBFC, such as a certificate for compliance with the 50/50 qualifying asset ratio, net owned fund computation, or any other RBI prescribed certificate?
Okay, so I will take up this question. See, the DNBS return is a mandatory return which is required to be filed by the NBFC. The next two which we have to talk about, the 50/50 return talks about the PBC, and the next one is the net owned fund. So these are transaction specific certificates which RBI can seek from you. Suppose if we are applying for a CO, or we can say there is change in control or change in management, anything, or say NBFC where stake has been acquired by another NBFC, then these certificates would be sought from RBI for ascertaining the assessment for the particular NBFC. There are other certificate as well which can be the classification of assets. So RBI can seek these in case of inspection or in case we are having any transactions that change in control or management.
We can just take like one question, Sadaf, and then we'll move on to the conclusion.
So the next question is, what are the items taken up mandatorily in Risk Management Committee and ALM as per SBR framework for NBFC?
I can take that up. ICAP is a mandatory requirement under SBR. So the entire ICAP policy needs to be formulated and placed to RMC and to the board for approval. So the entire capital planning has to be based on ICAP. Again, ICAP testing, periodic testing of ICAP is required to be placed to the RMC and then approved by the board. Other than that, I don't think the SBR mandates anything to be specifically placed to the RMC and board. All the risks under the organization's umbrella must be overseen by the risk management committee of the board. So risk management committee and the board. So ideally, all the risks that are applicable to the organization should be presented on, they should be quantified, presented, and the mitigation should be presented to the organization. In terms of ALM, again, the liquidity risk statement needs to be presented to it's not a mandate, but normally companies present their asset liability statement as part of liquidity risk to the risk management committees for their noting. And then, if there are normally regulations have, if the cumulative mismatch is more than 10% in any bucket, or there are specific ceilings that are prescribed, if the mismatches are higher in any particular bucket, in less than 1 year bucket, then specific actionables need to be taken. So if there are breaches in terms of liquidity risk management, then that needs to be specifically highlighted, and the board needs to put an action plan for how we will move those. But other than that, I don't think there are any specific mandates where the regulation under SBR requires to be tabled to the RMs. For the audit committee, there may be certain areas like management overlay of ECL, frauds. These need to be taken to for audit committee, but not to the RMs.
Understood. So with that, we come to the conclusion of today's webinar. So as we conclude today's webinar, I would like to extend my sincere gratitude to our moderator, Mr. Ankit Baid, and our distinguished panelists, CS Atharva Kale, Mr. Abhijit, Advocate Nihal Bashi, and CA Ganesh Iyer, for sharing their expertise, experiences, and valuable insights. I would also like to thank each one of our participants for joining us and contributing to today's discussion through your engagement and thoughtful questions. So we hope that today's session has provided some practical insight that will help you navigate this evolving landscape with greater clarity and confidence. So on behalf of Affluence Advisory, thank you once again for being a part of today's webinar. We look forward to welcoming you all to our future knowledge session. Have a wonderful day ahead.